in this episode, we're just going to go through some of the thought patterns that we use when looking at a potential business opportunity. So this would be good for someone looking to get into business or someone that's early on in their business life. So what process would you use if you were looking to see if a business is viable, like a business opportunity?
Yeah, so I would be first looking at the profit in both dollars and percentage that's associated with a product or a service. I'd then be looking at what startup costs, what fixed and variable costs are also associated with that business. And so your startup costs are obviously everything it costs to start the business. Your fixed costs are everything that remains constant throughout your trading year. Your variable costs are all the things that change as a result of the success or lack of success of your business, which we can delve into a little bit later.
So why would you consider the profit on a product or service before looking at the startup costs?
Yes, I definitely would look at the profit that's associated with a product first. Looking at the percentage of gross profit is a good way of understanding how you match up to industry standards, but for most people, it's easier just to work out the dollar value that's associated with a product. But the main reason I do that first before I look at the startup costs, which I understand the question completely, you're saying essentially, why would you even think about starting a business if you couldn't afford it, if the startup costs were too great? It's because there's a concept that a lot of people in the business space use, which is leaning into your reticular activating system. And so that's the part of the brain that sort of determines what's valuable to you. So you might have experienced this when you've been looking to buy a car. So you'll be on car sales, you'll be looking at the particular model, maybe the model a little bit higher, a little bit lower. So you're, determining, is this the best model for the best price? Or you might look at the kilometers, the colors that are associated with it, the locations that this vehicle is currently in. So if you need to go travel to it to be able to see the car in person. And so the more you focus on this, the more you research it, the more your brain sees it as something as valuable. It's leaning in to your reticular activating system. And so you might have noticed when you finally get to the stage of buying that car and you're driving it down the road, within the first week, you see so many more of that particular car on the road. And the reason is, it's not because as soon as you bought it, a whole bunch of other people went out and bought it in the suburb that you live in and now they're on the road, or that the manufacturer's just gone and made a whole bunch more. It's only because your brain now sees that as something valuable. The behavior that you have partaken in has now shown your brain that this thing that you've focused on is now valuable. And so you see it more often. And so for me to see business opportunities, I lean into that reticular activating system by finding the disproportionate profits that could be associated with a product or service. And then I can potentially see the opportunities that would come off the back of it. So it's way harder for me to sort of look at what are all the various costs associated with starting up a business and then seeing if it's a viable opportunity. I first just lean into my reticular activating system, see what profit is associated with that product, and then I can see the opportunities off the back of it. So it's something that I use to be able to find opportunities quick and just make sure that I'm seeing them when they're available.
Okay, so now that you've worked out the costs of the product and approaching this business, what are some other things that you would look for?
Yeah, so there's a few other concepts that I use just in the early stages of looking at an opportunity. So one is referred to as TAM, which is your total addressable market. I've kind of changed that because your total addressable market it's something that's usually associated with big businesses, and they'll look at, potentially expanding into new markets, the online opportunities and all the various, potential customers within a given market. And usually at a small business level, that's not something I can use, but I do use the concept of finding your addressable market. So when we were opening up the Mighty Macro business, doing the meals, we knew where our customers were, or the likelihood that people that were going to be interested in healthy meals were also going to be doing other healthy things like going to the gym. And so I already knew that when you approach gyms, they would often give you the member base size. And if you were nice enough, you could ask, well, what's actually your active member base? And so say they had 1,000 members, generally speaking, about 30% would be active. And so you might have 300 members that were attending the gym in any sort of frequent manner. And so I would try and get 1% of the market, of the active market in that given gym. That would be my goal to achieve. I would then go and look at all the various gyms in the areas that we were going to do taste testing, that we were going to have marketing to, And then I would find, well, if I gain 1% of the active market, what is the likelihood that I can do that? And what is then the size of that market? So I would look at my addressable market. Now, it becomes a little bit harder as soon as you have an online product because, technically you can go international and that sort of stuff. But for bricks and mortar stores or localized businesses, I would use some sort of method of finding your addressable market. So addressable market one, and the next one, then I want to know the lifetime value that's associated with the customer. So there's a few things that make up the lifetime value. There's the profit that's associated with the product or service. There's the frequency at which they're going to buy that product or service. And then there's the life of that particular customer. So how long on average does someone join the gym and stay? It might be 5 years. So you work out how much you sell your membership for, what's the frequency in which they pay, and how long they stay, and you have lifetime value. So you find the population size, addressable market, and you find out the lifetime value that's associated with that customer.
Yep. And then what's the next part to find out the level of need of your product and service in that market?
Yeah, so that's quite important, and that can actually be sometimes a bigger reason to go into business than even just the potential total market size. So I kind of use the 3 U's as the framework that I use to sort of see opportunities or see the strength of a product or service opportunity. And that is the market underserved? Is it an unavoidable product or service that you're offering? And is there any urgency that's associated with that product or service? And so if I use like the Crown Barbershop as, I guess, an example, this is actually something I used for that. And so I looked at the commercial retail spaces that were available that a barber could use, because obviously if the premise size is too big, the overheads that are going to be associated with that commercial lease are going to be too high, and eventually, even if you are a successful barber, the chances are it's not going to be efficient for that size of business. Then how many are even on the market? Like, is it easy to pick up a lease? How many other barbers are in the area? And so I looked at it and I'm like, there is not enough barbers for how many heads there are in Blacktown and the surrounding areas. And there's certainly not enough like supply of commercial property for that particular service. And this is like a particular service that's gone up in value for the business owner in, a recent sort of time frame. And so the underserved part of that equation was my biggest consideration. And so it's easy. Go drive around the area, go to a barber's on a Saturday morning and see what the wait times are. If the wait times are getting a bit ridiculous, there's not enough barbers, because there is a convenience and I guess a time factor that people will use in their decision-making process to purchase that product. So an underserved market is very important. I think if you looked at like a petrol station business, that's something that would quite easily tick all 3 of the U's. So is it a urgent product? Well, if your car's running out of petrol, yeah, it's pretty urgent if you want to continue using that car. Is it an unavoidable product or service? Well, yes, it's unavoidable. You must put petrol in the car for it to work. I know there's electricity vehicles coming, but that's a side note. We can deal with that situation later. And then is the market underserved? Now, this would be the biggest consideration if you were opening up a new petrol station. Is the population size or the traffic flow that's going past that particular business big enough for that business to work? Because it's certainly urgent, it's certainly unavoidable. Is it an underserved market? And that would be sort of the framework that I would use to sort of decide what is the strength of the product or service that we're offering.
So that's a good example of finding out where your customers are, the cost of things, and the 3 U's. But what are some other questions that you would ask if you were someone in business?
Yeah, so I guess that's looking at the overall business and I guess whether there's even profit associated with the product. But I think I would then like take a little bit more of a close look at the product itself. So if we look at the retail sort of sector, just because it's easy to explain and easy to explain, and I think when most people look at a business, they think retail. So you've got the value chain, right? So you've got the manufacturer, you might have the brand that's I guess associated with the product, you've got the distributor, and then you've got the retail level. So most people automatically think, well, I need to sell things to people, not necessarily other businesses. That'd be B2B, but they can be very good business models, but it's not usually the thought pattern people use. So they usually think, how do I sell products to people, which is the retail level. So not only knowing the profitability as a gross profit percentage and an actual dollar figure that should be associated, at a given section of retail, but actually the product itself as well. And so you might find that a lot of retailers may want to make 50% margin on a shirt. So you buy it for 20, you sell for 40. But if you were selling a bike helmet, you might find out, well, the production cost is actually $90, but they all sell for $600. So it's seeing like a disproportionate amount of profit that's associated with that particular retail product. But then again, you have to go back and look at, well, what is the frequency of purchase and what's the lifetime value? If someone buys one helmet, are they buying 3 in their lifetime? If someone buys one particular shirt off a particular retailer, are they likely to go buy 30 more? And so, yeah, knowing the profitability that's associated both at the retail level as a whole, but then within given products is something that you want to know.
Okay, cool. So the startup costs are kind of self-explanatory. What are the other barriers to entry when looking at a business opportunity or a business in general?
Yeah, so these are sometimes like less obvious. So obviously, as we said, you've got your market size, your lifetime value of a customer, what profit or percentage of gross profit should be associated with a given product or a given sector, being retail. Then you would look at, well, what are the barriers to entry for this particular business? Now, if you looked at our supplement stores, for example, that's quite an easy one to explain. So a barrier to entry is probably just the capital that's needed. You rent a retail space out, you put the products, in the store, and you can start trading. The actual barrier to entry is extremely small. What differentiates you is a completely different story. But quite often in small businesses, the real barrier to entry is just capital. Now, some people are thinking, well, that's a really big barrier to entry. Startup capital or capital needing to get into a certain business is actually not a hard barrier to entry. And it's because money for a startup venture can be achieved in a whole bunch of different ways. You can get money relatively easy. If it was a qualification that you needed, so if we needed to be, certified in supplement medicine therapeutics or something that was, obviously going to attract a large amount of prior education to be able to sell these products, that would be a heaps bigger barrier to entry. And the whole market would look different. You couldn't just go and hire people to work casual or full-time roles in an easy capacity. And the prices of those products would go up massively as well. And so often the barriers to entry can be things like qualifications. So, do you need to go get a degree to become a lawyer and open up your own firm? Or is it just capital, like opening up a retail store? And so your barriers to entry don't just need to be capital or qualifications. It could be access to products. And so if people are controlling the pipeline from up top, and they've got contracts that are with certain people, to get one of those contracts could be a very hard thing to do. So access to actual product or supply of product could be another barrier to entry. So sometimes even if you have the money, even if you have the qualification, you don't have the right network to even be able to execute an opportunity like that. So barriers to entry can be real. And the way that I would generally start to think about barriers to entry when I put it together a SWOT analysis. Now, there's not a whole bunch of stuff that I actually took from my business degree, but the SWOT analysis I think is usable. And so your SWOT analysis is what strengths, weaknesses, opportunities, and threats are associated with a given business or business opportunity.
Okay, so could you give me an example on what a SWOT analysis could look like for a business?
Yeah, so if I use our first retail store at Blacktown. So strengths can be anything from you're really good looking and you're selling health products. Like that can literally be a strength. It might not have been one that I was able to put down as a strength in my SWOT analysis, but it certainly is. If you're good looking and you're selling like a product that's supposed to help you be better looking, it can absolutely be a strength. So sometimes it's less obvious things. It's less technical than what you might think. Another strength might be the location that you're able to get, the commercial property that's available, is in a very high foot traffic area and it's next to 3 gyms and you're selling health products. So the strength could be the location that you've picked. Another strength might be that in comparison to your competitors, you have an advantage in a given area. And so often, if you want to compete in business, finding out where your competitor is not actually operating well especially if it's an area that you are operating well in, it's an obvious strength, and it can be one of the best reasons to go and compete as soon as you first find out your addressable market size, the lifetime value, the startup cost, and all the other things that we've mentioned. But yeah, seeing how your competitor operates and seeing the strengths that you have against that can be very good. Another strength could be, as I said, being able to access a certain brand or a certain product that other people don't have access to. So exclusivity. Then you go down to the weaknesses. Now, I think the weaknesses, you could almost just classify this as what level of self-awareness do you have? The weaknesses that are associated with your business. Okay, so is the premise that you've got like big enough, or the premises that you've got big enough? Do you have enough startup capital to actually do the project well? Are you in a low foot traffic like location? Do you have the ability to sell your products sort of in an engaging way? And so if we looked at the weaknesses that were associated with our first business model, absolutely, we had a poor foot traffic area. We didn't have enough startup capital, but we did have quite a few strengths that allowed us to compete against some bigger players. The opportunities that are associated, this is something that I've definitely probably developed more so over time, because as your business, I guess, acumen grows and your network grows and your ability to be resourceful, you can find opportunities where other people might not see that they exist. But at a retail store level for supplements, for example, I would be saying, do I have the ability to vertically integrate? Do I have the ability to make some of my own products, achieve higher levels of margin, offering myself both exclusivity, because they can't get it anywhere else, higher margins, and do I have the ability to even build a better product as well? So if that's an opportunity that currently exists, that could be a very strong one. Threats, you'd start to look at probably more things like new market entrants. So what's the likelihood that you're going to be competing against other people in, I guess, a sort of short time frame or a long time horizon? And that's something we've absolutely had to deal with. So in Blacktown, Mount Druitt, and Penrith, we've had big box or bigger chains move into every single one of those areas. And before they moved in, I literally had said to Mark on many occasions, 6 to 12 months, we're going to have another competitor for sure. And sure enough, it happens. And it's because the way that I'm seeing these business opportunities is the exact same way that other people are seeing it as well. But you need to understand those threats, because if you are not profitable by a given time and a new market entrant comes in, your chance of achieving profitability in the future decreases massively. Or if the model that you're starting with is dependent on a certain size of customer base and it wouldn't work outside of that, or if there was any sort of like room for error, it would completely fail, then you probably shouldn't go in to start with, because if new market entrants are likely to come in, there's a small barrier to entry, it's just capital, then yeah, you're probably going to be competing against other people. So that's how I would start to think of like your strengths, weaknesses, opportunities, and threats when you're looking at any sort of given business opportunity.
Awesome. Did you want to quickly look at the different types of business models that you see as well?
Yeah, so this is an interesting one. So often in business, you do have like quite a few, I guess, terms or terminology that's interchangeable. And so business models could be described in so many different ways. You might hear someone say, oh, well, that's a price point model, which is just really referring to the price that's the product that they're selling has. And so it's obviously trying to, I guess, target or penetrate a price sensitive portion of the market. But then you've got other people saying, well, that's a retail model. And it's kind of, you're talking about two very different things. But generally speaking, people sort of recognize, well, that's a retail model, that's a subscription model, that's a franchise model, that's a mobile model. Like the model of your business it usually speaks to how it sort of operates. But as sort of the market gets more competitive, models become more integrated over time. So you could easily have a retail model that's inside a franchise that offers subscriptions, that is using price point as its main sort of, I guess, service offering. And so you sort of get a hybrid of these various models. But the way that I usually think of business models that I find helpful to me is by just using this little phrase. Your business's model is how you create and deliver value profitably and sustainably. And so if you looked at, again, one of our retail stores, just because people would be, I guess, familiar with that now, how we create value, how we deliver it. So we create value by offering an educational side to the products. These products can be purchased at many different places online, but it's the education that we give to the customer that helps them know whether that product is right for them. How we deliver it, well, we deliver it at a retail location. We use social media to educate them before they even come in. How do we do that sustainably and profitably? Well, that's kind of back-end stuff. Like, is there profit in the products that you're selling? Is the overheads of your business, again, so looking at the initial conversation we had, are the fixed, variable, and startup cost all in alignment so that this can be profitable? How do you do that sustainably? Well, that's more up to the actual operation side of the business. How are you doing this in a sustainable way? And so one of the ways that we achieve sustainability is by giving equity away in some of the businesses that we hold to the people that are actually operating it. And so we train them up, we try and give all the values that are in us to those people, but then we remove the ceiling of what they can earn by actually giving them ownership in the business. Now, a lot of business owners would never do that, but for us to be sustainable in the future, our belief is if you can incentivize people in a way to keep doing their best and wanting to do the best, then essentially what you're saying is you want them to act as if the business is theirs. Well, no one's going to do that if the business is not really theirs, or they're only going to do it for a short time. So why not make part of the business theirs? So many people are so concerned away with giving away equity in a business because they're like, no, it's mine. It's just like, well, what's the purpose of that business? If it is to produce profit sustainably, this is your business model, then why not like lift the cap of the work that someone's like willing to do so that you can be more profitable, sustainable in the future? And so my basic belief around this is if you give 10% away of your business to someone, but the work ethic and the value that they're going to create inside that business is going to make it 10%, 20% more profitable, then what have you lost? If you're not going to sell the business, if you're not preparing it for sale, then why not give equity away? Like the level of profitability that's associated with that business could vastly increase sustainably. And so that's a part of the business model that we've chosen.
But I think that's a good framework to work with to see to see whether or not a business is viable or not. Did you want to just give like a brief overview of everything we went through in case someone listening is like, cool, this is mad, I need to digest more of this?
Yeah, so this is more just like an introduction into the way that you would approach a business opportunity, or maybe some of the questions that if you didn't ask when you opened up a business, you should be asking now so that you can pivot if you need to. But yeah, essentially, we look at the profit that's associated with a product or service. We look at the addressable market size. We look at the lifetime value of a customer, which is a combination of what profit is associated with the product, the frequency of purchase, and how long they generally stay as a customer. We then look at the barriers to entry, which, as I said, could be things like the qualification that you might need. Is it just startup capital? Is it access to product and supplies? Is it a network that you need to achieve? Then you go back one layer again and you can look at the SWOT analysis, which is your strengths, weaknesses, opportunities, and threats. And then you can sort of go a little bit more granular and get the context of the market and look at your competitors and see where it is that you may have a competitive advantage, and having I guess a high enough level of self-awareness to know where your weaknesses are as well, so that you can kind of hedge against those. And then finally looking at the business model. So that's how you create value, how you deliver value, how you do that profitably, and how you do that sustainably. And so often that will work into the very business structure itself. Are you an owner operator? Are you in a partnership? Are you in a company? Are you willing to give away equity to the people that are operating those businesses? And are you using a hybrid sort of business model, which might be a retailer that's inside a franchise that is using subscriptions, that does have a mobile capacity? Are you integrating as many sort of models within your structure? And so, yeah, I think that's a pretty good way of thinking about a given business opportunity. And I think knowing what profits should be associated with different industries so that you can lean into that particular activating system and see where those opportunities exist in sort of like a fast way, and a way that allows you to see what's valuable right from the get-go.
And if someone listening to this is thinking about starting a business and everything you just said seems a little bit overwhelming, would you still say that all of this is just basic business principles?
I would say it's basic business principles, but I would say I don't often actually see this level of thought or research or the understanding of these concepts being used by small business owners. I think usually business owners are moving into established markets. And so this is, I guess, a business blueprint that everyone sort of understands. Like, there's nothing complex about selling supplements out of a retail store. Everyone understands the concept. But if you haven't done, sort of that prior level of thought that we talked about, the chance of success definitely differs. There are a lot of stores that have closed down in the last 5 years, and it's so easy from the outside to see why they have failed. And usually it's one of those things that they've just really missed out on.
And if anyone listening is wanting to start up a business or come across a business opportunity, you do offer business consulting. Is that correct?
Yeah, exactly. So whether you are in business or wanting to start a business, we can sit down, look at the actual opportunity that you're talking about, and go over a lot of the things that we've just discussed. And we can probably, as I said, get a little bit more granular and look at some more of the specifics, and hopefully just offer some industry insights. And I think take a heavy marketing focus towards these sorts of consults as well, because before you sell anything to anyone, you must have their attention. And attention is a very valuable commodity in today's age, and knowing how to get it can really largely dictate how probable, your success of being in business is.
Awesome. So I hope this episode gave the people listening some insight into what goes into the level of thought of coming across a business opportunity or starting up a business. And again, if you want, a personalized service from Steve, then we'll leave all the details below if you do want to go into a business or marketing consult with him.
Yeah, cool.